And now the floor is to the World Bank. Today with us is Mr. Cyril Muller. Muller is where from? It's German? Switzerland, okay. Is the Vice President of Europe and Central Asia World Bank Group. The floor is yours.
Thank you very much. Ladies and gentlemen, I want to congratulate the Delphi Economic Forum for choosing the challenge of inclusive growth as the theme of this year's forum. This is not only a very timely topic at a time of slowing global growth and increasing inequality, but it also actually reflects the goals of the World Bank, which are to eliminate extreme poverty and to boost shared prosperity. I will focus my remarks on making the case for inclusive growth. Discussing how to make growth inclusive is more important than ever. Over the last decade, we have seen significant shifts in the global economy that affect Greece and neighboring countries alike. And I will focus today only on one such big shift: technological change. Rapid and disruptive technological change is widening economic and social gaps between countries, regions, firms, and households. While technology offers ever richer opportunities for well-skilled workers and frontier firms, low-skilled workers and less productive firms risk falling behind. These growing divides at the firm and at the citizens level actually threaten social cohesion. And that translates into polarization, not least in the political sphere. These divides also manifest themselves in terms of growing income inequality within countries, spatial tensions between rural and urban areas, and differences in the job markets between young and older workers. These clearly call for a renewed and serious discussion about how to achieve inclusive growth. I am pleased to see that governments across Europe, and actually throughout the world, are increasingly asking the World Bank to focus on how to make growth inclusive. So what does it take? Our research and experience shows that to achieve in these rapidly changing circumstances, inclusive growth, countries have to invest in people and create the right conditions for firms to thrive. Both go together. And now let me elaborate. First, I want to make the case at the firm level. Over the last 2 decades, technological change has been a major force in widening productivity gaps between firms as well as between countries and regions in Europe and elsewhere. First, location matters. Highly productive and innovative firms choose locations that provide attractive conditions for investment, for innovation, and for growth. The business environment, therefore, matters more than ever before. Every year, the World Bank ranks the business climate in 190 economies around the world in our Doing Business assessment. In 2018, the global leader was actually New Zealand, and Greece ranked 72nd. Among the Doing Business indicators where Greece scored highly, actually scored best, it was in the ease of starting a business and trading across border. Greece, on the other hand, does worse in the areas of enforcing contracts and registering property. This year, the World Bank will be carrying out an assessment of the business environment in Greece in all major cities to provide a more detailed and relevant picture. Let me now make the case for opportunities for people. Focusing on firms alone will not be enough. Opportunities for people matter in equal measure. We need to prepare people better for the prospects of accelerating technological change, and this is squarely a question about skills. We do not know what technical skills will be in demand in the future, but we do know that everyone needs strong foundational skills, such as reading and mathematics, as well as problem solving and critical thinking. Greece has a strong track record in young people attending university, but it does lag behind most European countries in ensuring that all its children have strong foundational skills. As many as 36% of 15-year-olds in Greece fail the PISA test of basic proficiency in mathematics. While preparing young people for the future is important, many advanced economies also face the challenge of an aging population. In this context, facilitating continuous learning and healthy living is becoming critical to raise productivity and achieve inclusive and sustainable growth. The World Bank recently launched the Human Capital Index, if you want a similar index to the Doing Business report, to indicate how much human capital a child born today can expect to attain by the age of 18. The index reflects literacy and numeracy skills, as well as dimensions of child and adult health. In this ranking, the global leader is Singapore, where a child born today is 88% likely to achieve his or her fullest potential. The corresponding figure for the EU 15 is 77%, and for Greece, 68%. As returns to skills are very large, the case for continuous investment in people couldn't be stronger. In closing, ladies and gentlemen, I hope that my remarks will contribute to this important debate on how to ensure that growth benefits all. In 2019, the question is no longer to choose between growth and inclusion. It is about how growth and inclusion can reinforce each other. Thank you.
Thank you. Thank you very much for your remarks. So we have, let's say, 5 minutes. You can take your seat there. For some questions from the audience. Λοιπόν, από εσάς έχει σημασία να ακούσουμε κάποιες γρήγορες ερωτήσεις. Παρακαλώ. Ελάτε.
Okay, thank you very much. And notwithstanding the real contribution of both the EIB and the World Bank in the Greek economy, still Greece remains a paradise for hedge funds selling business at 10, 11, 12, 13%, and so on and so forth. How can a Greek company borrowing at these rates, even from banks, around 8, 9%, compete with a German company at 2%? What type of common market is this? And do you have any plan to deal with this problem? Thank you.
This is a question for both. You have 1 minute each in order to take one more question. You can start. You can start with that.
Well, in 1 minute, I mean, obviously the fragmentation of the banking system, the renationalization of banking systems in Europe has been a feature of the crisis. And this is something, obviously, that the EU is seeking to reverse through banking union. In other words, trying to separate the costs of private sector financing in countries from the sovereign credit rating, trying to break that doom loop between sovereigns and banks. That's the fundamental purpose of banking union. Clearly, progress has been made. It's incomplete, and further progress needs to be made in both banking union and obviously in capital markets union more generally. The EIB, for its own part, is obviously seeking through its own financing to pass its low funding costs on. We're a AAA bank, and we seek to pass those low funding costs on to SMEs and other private sector actors in Greece. But obviously, there's only so much any individual bank can do. We will continue to finance considerable amounts of private sector investment here, but the only real sustainable solution is the completion of banking union and capital markets union.
Let me actually emphasize that the question is highly relevant. Actually, EIB, the World Bank, EBRD, and others, and the World Bank through IFC, have focused really our financial programs in actually addressing the problems of these 4 systemic banks. Actually, Greece had graduated from the World Bank, but following the crisis, we made an exception to our policies to be able to support this transformation of the Greek economy. I think part of the issue also that is at stake here, besides the fact of the financing terms, is to rebuild trust in the financial system, so deepening it, broadening it. And the second aspect of it is the building the credibility and trust in Greece as an investment location for the long term. I think the economic and social transformation of the country will be key. And I think if we really think about how Greece can lift its growth potential going forward, it will actually take Greece to both focus on investing in people and having really firms being able to compete in global and regional markets. I have to say one element for which we are very optimistic with Greece is, and I heard that today during some of the sessions, is that Greece is becoming very competitive in some of the new technology sectors, and you have really entrepreneurial new firms that need to find a way to grow. If that happens, then I think these issues around the financing will actually sort themselves out within the framework that you highlighted.
I think we're running out of time. Thank you very much for your comments and your contribution to the discussion. And I hope you enjoy the rest of the forum. Thank you.